You've spent weeks testing your strategy. The historical data shows a 65% win rate, yielding a steady, climbing line of consistent profit. So you take it live. But within 20 trades, your account drops 25%. A loss this deep never appeared in your historical data. A strategy with perfect historical indicators can still collapse under the weight of a live market, even when the underlying logic remains sound. This is the backtest illusion, the assumption that the specific order of past trades will repeat itself exactly in the future. In reality, historical data shows you only one possible past, a single path that rarely repeats in the same sequence. A positive mathematical expectancy only guarantees a return across the long run. It does nothing to protect you from a short-term sequence of losses that could drain your account before that profit ever arrives. To identify these failure points, professional traders use a Monte Carlo simulation. This acts as an engineering stress test for your capital, shuffling your historical data to reveal thousands of alternate futures. This shuffles the deck to expose sequence risk. This is the danger that a concentrated cluster of losing trades will hit your account before your strategy has enough time to play out. Consider a setup with a 50% win rate and a 1-to-2 risk-reward ratio. Over 100 trades, it's profitable. In a backtest, wins and losses alternate nicely. But probability dictates trades will arrange differently. What if 10 losses hit you sequentially on day one? If you are risking 5% of your capital per trade, 10 losses in a row means your account is down 50% before you register a single win. Your edge only guarantees returns if you have enough capital to survive the statistical variance of the short term. Managing that variance requires precise position sizing, which starts by identifying your uncle point. This is your terminal drawdown, the specific percentage of loss where you either run out of capital or lose the psychological will to continue the strategy. This chart plots your risk per trade against your probability of ruin. Notice the shape. Scaling up your trade size doesn't increase your risk in a straight line. The danger scales exponentially. With a 55% win rate, risking 1% per trade gives you a 2% chance of hitting your terminal drawdown. But if you increase risk to 3%, the probability of complete account ruin jumps to 40%. This probability curve provides a specific mathematical boundary for your capital. Without it, your position sizing relies on guesswork rather than hard data. To map this variance, the simulation runs your data through 1,000 random iterations. This generates a spaghetti chart showing thousands of different paths your account balance could take. To find your maximum likely drawdown, we ignore the average results. We strip away the top 95% of outcomes to focus exclusively on the absolute worst-case sequences. Even then, standard models often assume markets follow a normal bell curve. In reality, markets have fat tails, extreme outliers that happen more often than a simple coin flip model suggests. This chart of the 2020 COVID crash shows a V-shaped plunge occurring exactly at the March 16th marker. This is a level of volatility that defies normal distribution models. These shocks are often driven by human catalysts, such as the Swiss National Bank officials seen here during the 2015 removal of the currency peg floor, an event that decimated accounts overnight. A robust strategy must manually inject these massive outlier losses into its datasets to ensure the risk management plan survives an unpredictable shock. While an amateur trader hopes a backtest repeats perfectly, a professional manager expects and prepares for statistical variance. Calculating your true worst-case scenario before you trade provides the data needed to sit through a drawdown without questioning the system. Stop guessing how much risk your account can handle. Download the FXNX Strategy Stress Test tool to determine your maximum likely drawdown and trade using a data-driven safety net.